Thank you, everybody. I think we're going to get started now. Thanks again for everybody who's signed up for another in a series of options-related education seminars brought to you by BMO InvestorLine in partnership with the Montreal Exchange. Today, our presenter, Jayson Ayres, will talk about how to use options in an RRSP and TFSA account. Just a note for all participants, there will be a Q&A period at the end of the presentation. You'll be able to submit questions by hovering to the right of your web window. There's a Q&A box. Submit your question there. We'll do our best to get to any questions submitted during the session. Further note is we will be posting a recording of this presentation for later review within the next couple of weeks under our Learning Center. It's available within the InvestorLine website. Without further ado, I'll turn it over to Jayson.
All right, great stuff. Thanks very much. I guess just a quick confirmation that the audio is in fact working before I get too far into the presentation.
We can hear you fine, Jayson.
Okay, fantastic. Good stuff. Well, thanks very much for joining in this afternoon. And as mentioned, we're going to take a look at how we can use options in our RRSPs and our TFSAs. As usual, we want to make sure that everybody understands that tonight's presentation or this afternoon's presentation is for educational purposes only. And while we can use options for a number of different to meet a number of different objectives, including hedging risk, we still want to make sure that there are certain strategies that can be risky. We want to make sure that we understand those risks before we start clicking the buttons. So, with that in mind, as we push forward here through the presentation, what we want to first tackle is a look at what our objectives are in terms of what we're trying to accomplish within our registered accounts. I'm not sure whether, oh, there we go, good. Sorry, the slides weren't advancing forward, but hopefully you guys are able to see our agenda here. As I mentioned, we want to take a look at our objectives and considerations for strategies that we're looking to incorporate in our registered accounts. We want to focus on what strategies are in fact eligible within our registered accounts, and we're going to look at buying calls, so going along a call option, buying puts, so going along a put option, and those would be strategies where we can use options to trade a directional view. And then we're going to look at implementing the covered call strategy as a way of generating cash flow, and then finally we'll take a look at integrating the protective put as a mechanism for hedging our risk. So what are we looking to accomplish typically when we're considering strategies within our registered accounts? Well, first of all, many of us are looking to create a comfortable retirement for ourselves, and as a result, we might be looking at being a little bit more conservative and focused perhaps on income generation and cash flow before before looking at taking on any sort of leveraged positions or any sort of positions where we're focused on taking advantage of directional moves. We also want to prevent substantial drawdowns for our RRSP payouts as well. So again, just hedging the risk associated with being invested in the markets and protecting that capital so that we have cash flow for ourselves to draw on during our retirement. From the perspective of utilizing our tax-free savings accounts, the idea of compounding growth, so being able to take advantage of some of these option strategies and over a consistent period of time looking at implementing these strategies and then redeploying the capital and so on and so forth, so we can grow that tax-free savings account as effectively and as efficiently as possible. And the other consideration, of course, is ensuring funds for our children's educations. Many folks don't recognize that we can use a number of these option strategies, well, all of these option strategies that we're going to be discussing here this evening in our children's education funds as well. So it just adds another mechanism by which we can grow that capital, especially since it's getting so expensive these days to put a kid through school. So again, the main priorities are going to be protection of funds, consistency in returns, leverage with managed risk, and so the first strategy that we're going to look at is the idea of buying calls instead of buying stocks or exchange-traded funds. We're going to give you guys an example of that. So we're going to be looking at buying calls instead of buying stocks or ETFs, and we'll talk a little bit about the rationale behind that. Buying calls to secure the future purchase price of a stock that we would like to hold, and a great consideration for that would be perhaps that we like today's price, let's say on Barrick's gold, but we don't have the capital right now in order to purchase those shares. The risk, of course, is if we don't buy today, it might be substantially higher 6 months from now. So we could use a call option to secure today's price and hold that price, or the right to buy the stock at today's price, until we actually have the capital available where we can exercise our right and buy the shares. So it's a great way to take advantage of an opportunity that we see in the market today and lock in today's price while we wait to generate cash flow, perhaps through the sale of property or what have you, and then and deposit it in our registered accounts for use in that share purchase. Covered call writing as well, very, very, I think, powerful strategy that many investors have yet to really embrace. If we take a look at how most of the returns have been generated in the markets over the last 30 years, it's been essentially on dividends and interest. And so if we can actually add one more element to that, and we consider looking at covered call writing as a way to increase that yield, and then further to that, again, redeploy that capital and compound that capital as we're benefiting from sustained growth in a stock, then to me it just gives us an edge over what most folks are doing presently. The other consideration, of course, is that we know markets don't always go up, although over the last few years certainly that seems to be the case. But we want to recognize, of course, that there are times in the market where it is better to be either on the sidelines or better to know how to take advantage of a bearish market environment. So this is where buying put options as a replacement strategy for short-selling stock becomes an interesting consideration. Doesn't necessarily even have to be within a bearish market environment, but if you happen to have an inclination that a particular stock may be lining up to make a drop to the downside, then we can use put options as a way to speculate. Of course, we have to understand, of course, that we can't short sell stock in our registered accounts, but we can buy put options. So this gives us a way to participate with a bearish directional bias where otherwise we would typically not be able to do so. And finally, we'll take a look at protective puts, so a way that we can essentially create a little insurance policy around our holdings to hedge against the potential drop in the market. So let's first of all take a look at just some general considerations when it comes to the options market. I know for a lot of you guys this is going to be review. I think it's always important to make sure that we understand the basic principles before we look at the strategies. And so we want to understand that the options market is all about our rights and obligations, and in fact it doesn't matter what strategy you're looking to construct. It doesn't matter what objectives you're looking to meet. It's all going to come down to you understanding the rights and obligations associated with the positions that you've created. And so, of course, we have two different types of options that we can use, the call option and the put option. And I remember an old saying from the perspective of being the options buyer that helped remember, what you would use each for. And it was that if you thought the stock was going up, you would buy a call option. So you would think, call up your broker. And if you thought that the stock was going to be going down, you would buy a put option. So you would put down the phone. So it's kind of a simple way for those of you that are just starting to understand the dynamics of the options market that you can remember when you would be a call buyer versus when you would be a put buyer. You call up your broker, you put down the phone. Now, when we buy a call option, we're actually paying a premium that secures the right for us to own shares at a specific price over a period of time. And it has a number of benefits that we'll obviously get into considering as we move forward. But we want to recognize that that premium goes to the option writer or the option seller. And that premium is collected by that option writer, and that option writer will take on an obligation. That obligation is, of course, the opposite to the buyer. That's to deliver the shares at a specific price over a specific period of time. And the seller's rights in that case, in the case of the call option, is they get to keep the premium from selling the option. So regardless of what happens with the underlying shares, regardless of whether or not they have to follow through on their obligations, the option seller still gets to keep the premium. The only time that they'll get to keep the full premium, of course, without having to follow through with their obligations is if the stock or if that option contract is what we refer to be out of the money on expiration. Okay. Now, the put option buyer pays a premium, and they secure the right to sell shares at a specific price over a certain period of time. And so the idea is that as the share value drops, the put option premium increases in value. So I find people tend to understand this a little bit more effectively when they think of it from an insurance standpoint. So of course, you know, if you get into a car accident, your premiums are going to go higher. So if the stock gets into an accident, if the stock sells off or drops in value, the put option premium is going to appreciate in value. Now that premium gets paid to the option writer. The put option writer collects that premium and takes on an obligation. They have to buy the shares at a specific price over that time frame. Now, the only time that their obligation is going to have to be fulfilled is if the share value is below the written strike, in which case the put option will be considered to be in the money. Now, they would still get to keep the premium, but they're going to have to fulfill their obligations. Okay, and the great thing about the options market is that we really don't care who is buying or selling the calls or who are buying or selling the puts. It's really about what are we trying to accomplish, and it's really about what our rights and obligations are based on, you know, the strategies that we feel are appropriate. We want to understand as well that within the options market, we're not trading with or against one another. There is in fact a market maker that is facilitating the transactions, which means that, you know, I can buy a call option without having somebody else having to sell that call option. The market maker is going to do that for us. So it allows us to create some really interesting positions in the market based on meeting certain objectives, and allows us to buy and sell these option contracts, you know, at our discretion, provided, of course, that there's still a value for those option contracts, and create some pretty interesting combinations. Now, when it comes to just a general understanding of the contract specifications, it's very important to understand that one contract represents 100 shares. That's important because the strategies that we're going to talk about here this afternoon, a lot of them will be in combination with owning the underlying shares. So we want to know how many call options can we write based on the number of shares that we own, or how many put options do we need to buy in order to be effectively hedged based on the number of shares we own. And so we want to understand that one contract represents 100 shares. The price of the contract is listed in a per share basis, and so when we look at the cost of the contract or the price of the contract when we're reviewing it within our brokerage platform, we're going to take that number, we're going to multiply that by 100. So if we're looking at a premium of $1.25, let's say, well, then that means that we would be paying $125 per contract. Now, each contract has a unique strike price, and each contract has a unique expiration date. So that means that there are hundreds and hundreds and hundreds of contracts that will typically be listed for any one specific options eligible stocks, and it can be a little overwhelming. And so that's why it's really, really important to make sure that before you get in and start, you know, trying to figure out which is the right option contract, make sure you know what objectives you're trying to meet, and have sort of a general idea as to what strategy or which option contracts are going to work to meet those objectives. And that way, you're going to save yourself a lot of time and effort going through all of the different contracts available. The first approach that we're going to look at, we're going to keep it really simple. We're going to look at buying call options in our RRSPs, and TFSAs. And as I mentioned earlier on, there's a number of reasons why you would consider using a call option as opposed to buying the stock itself. But really, at the end of the day, your objective here is that you have a directional bias to the upside on the stock. And rather than buying the underlying security, so rather than buying the stock, you're looking at a way that you can replace that stock. And the benefit, of course, is that you're able to leverage your capital quite significantly, but at the same time, you only risk the premium that you paid out. So you get to pay a small amount to benefit from an increase in the share value, and you can't lose any more than the premium that you've paid. Now, this may seem like a no-brainer, like a foolproof operation here, if you will, but we want to recognize that there is a time limit by which we have for that stock to move in our favor. And where I see the biggest challenge for a novice option traders, whether it's inside a registered account or outside a registered account, it's making sure that they give themselves sufficient amount of time, because if the stock doesn't move within the time frame allocated to that option contract, of course the option contract is worth zero and the option buyer loses their entire premium. So even though you can't lose more than the premium you've paid, you still need to be sensitive to that time depreciation factor. So here's just an example that we're looking on March 26 at considering buying 100 shares of Barrick at $20 per share. So you're looking at paying out about $2,000. And of course, understand that if we're doing this in our registered account, we can't buy stock on margin. A lot of folks would say, well, if I'm doing this in a non-registered account, I'd only have to put up maybe $800 or what have you. Typically, 1/3 of the value of the underlying shares is what your margin requirement is. So you're leveraging your capital. Well, you can't do that in your registered account, and so you'd have to put up the full amount here, in which case you'd be putting up $2,000. Now, whether it's $2,000 or $20,000 if you bought 1,000 shares, the bottom line is that your risk is undefined. And when it comes to trading and investing, one of the most important considerations is knowing what your risks are. Now, of course, you have the benefit if the shares, let's say, rally between now and the third Friday of October, which happens to be October 18th, 2014. If the shares rally up to $25, well, you have the benefit of generating that $5 in return. So your risk is undefined, but you have an unlimited upside potential. Now, we could take that same outlook on the stock, and instead of buying those 100 shares and putting up $2,000, we could buy one October 20 strike call option and pay $2 per share. Now, remember, we talked about the multiplier. The multiplier is going to be 100. So we multiply $2 times 100, and the cost of that option is going to be $200. So rather than buying the shares at $20, what we've done is we've purchased an option contract that gives us the right to own those shares at $20 between now and the third Friday of October, and the cost is going to be $2, and that's our maximum risk exposure. So if Barrick happens to drop back down to $15 within that time frame, as the shareholder, you would be down $5. As the option holder, you would be you could only lose the maximum of $2, and that maximum loss is only recognized on the expiration. So if we consider the same move to the downside, recognize we immediately know our risk is limited to $2, and so we can then take a look at the upside potential, and if the stock does the exact same thing within the time frame that we've allocated and it hits that $25, that $20 strike call is going to have an intrinsic value of $5. And if you guys recall back to your options basics, we determined that by taking the share price and subtracting the strike price. We take 25, we minus 20, and that gives us the intrinsic value of $5. Remember, on expiration, an option contract will only be worth its intrinsic value. So in this case, we have the right to own the shares at 20, and we could turn around and sell those shares back to the market at 25. which means that we have the opportunity to make $5. Or we could just simply sell that call option back to the market and collect our $5. But remember, we paid $2. Now, that $2 was what we refer to as time value. And time value is always 0 on expiration, which means we have to back that out of the profits that we've generated. So we have to back that out of the value of the option contract. But what you'll see here is that even though we have to subtract the $2 in order to determine what our profit was, you'll recognize that we've still, for our $2 risk, we had the opportunity to make a $3 profit. So the idea is that we've created what's referred to as an asymmetrical risk-reward opportunity here, where our risk is less than what our profit potential is. And of course, if the shares were at $30, well then that option contract would be worth $10, and so on and so forth. And so we want to recognize that when we buy the call option, we have the unlimited profit potential as well. Okay. Now, we can also take a bearish stance if we have an inclination that a particular stock or the market in general was going to drop in value. We could actually turn around and instead of short selling the stock, which we can't do in our RRSPs, what we do is we buy a put option, and that put option gives us an opportunity to leverage our capital, and we also can't lose more than the premium we've paid. So we have a lot of the same characteristics and benefits of the call option, except we're just simply taking advantage of the opposite directional bias. And so if we take a look at, I was looking at, let's say, Tim Hortons as an example, maybe a little overbought, and looking at the shares being up around that $60 level, we could in fact short sell the stock in a non-registered account and take advantage of the stock dropping in value. Now, of course, if the shares go up in value, the short seller has an obligation to return those shares to their rightful owner, in a manner of speaking. And so what happens is if the short seller borrows the shares at 60 and sells them, they collect $60 per share. The idea is that if the shares drop down to 55, well, they basically buy the cover at 55, they deliver the shares back at 55, and they keep the $5 difference. The challenge, of course, is that if the market turns around and goes up in value, they short it at 60, but they have to cover at a higher price. And so as the share value goes increases, it goes up in value, what happens is, of course, is the short seller has an unlimited and undefined risk exposure. Now, if the shares, let's say we were looking at a time frame out to July, if the shares drop down to $55 within that time frame, you're going to make $5 per share. Now, the alternative is we would buy one Tim Hortons July 60 strike put, and in that case, it was listed for $2.15. Now, that would cost us, once again, we multiply by 100, so that would cost us $215. Our risk is limited to $2.15 per share, but our profit potential is unlimited. And if we were looking at the shares settling at $55 within that same time frame, once again, we have a $5 intrinsic value. We take 60, which is our the strike of our put, and in this case, we subtract the current stock price or the settlement value, which would be 55. We have a $5 intrinsic value, and then we subtract the premium that we paid out because that was all time value, and from there we are looking at a potential profit of $2.85. So once again, we have that that asymmetrical risk-reward opportunity where we have a limited and identifiable risk exposure and an unlimited profit potential. Now, the thing about being able to utilize both calls and puts in your portfolio in your RRSP or your TFSA is that you have a limited risk exposure, and so you really have an opportunity to be very comfortable with how much capital you're allocating or how much capital you're risking at any one given time in a directional opportunity. And what that allows you to do is be a little bit more comfortable. So in other words, if you're looking at that dollar value that you're deploying to take advantage of an opportunity, and if you're uncomfortable about the risk of losing that entire amount, well, then you probably should reduce the position size or reduce the number of contracts you're purchasing before you actually click the button, because you can immediately see just what the maximum risk is. Now, what you've also done is you've leveraged your capital in both cases, and so it becomes a very interesting consideration for a tax-free savings account where you don't have the the luxury of depositing a substantial amount of capital at any given time. I think we're up to about 25 grand now is where we're at in terms of how much we can deposit, but understand that if you're looking to diversify your account across a number of different positions, it may be hard to do so if you're having to buy the shares of all of the underlying stocks. But if you're buying call options or call leaps, if you will. So, leaps, well, is a U.S. term. In Canada, they're just longer dated options. But if you're using options that expire, 1 year out, then you have a bit more of a passive approach to managing your tax-free savings account. But you have an opportunity to take advantage of that leveraging characteristic. Now, the big consideration is that when you buy a call and a put, they both have a time limit, and you do risk losing the entire premium if the stock doesn't move, and it's an absolute loss. And so what we want to understand very, very clearly is that if you let an option contract expire worthless, that is a realized loss. That's gone, and that means that you have to make that back and then some on the next opportunity. Unlike the person who buys the shares, if you're sitting with a loss on a month-over-month basis, provided that the stock stays in business, you can continue to hold on to that losing position. And so it's important as the option buyer, if you're speculating on a directional opportunity, to make sure that you're prepared to manage that position proactively, make sure that you're prepared to cut your losses, or don't allocate any more capital to the opportunity than you're comfortable losing. Okay. A lot of times the biggest challenge, and I think I mentioned this already, that novice options traders face is the idea of bringing their traditional buy and hold mentality into the options buying world, and it just doesn't mix. If you buy and hold an option contract, there's the potential that you could lose that entire premium. You may be profitable, but then ultimately you may find as time passes by, the stock turns and goes the opposite direction. You're no longer profitable, and you have to realize a 100% loss. So very, very important to be sensitive to that. And again, an investor cannot short sell stock in their registered accounts. Now, the industry has done a very good job at creating, interesting products that you can buy in your registered accounts that give you an exposure to a bearish market environment. So, for example, you could buy what they call inverse ETFs. So, in other words, they're exchange-traded funds that are essentially comprised of short positions in the market in a particular sector. And as that particular sector goes down in value, the ETF goes up in value. So technically, while you are benefiting from a bearish market, you're not actually short stock. You're not actually short anything. You've gone long shares of an ETF. It's just kind of a way to get around that rule. But recognize that there are limitations. there are only so many inverse ETFs available to an investor, whereas there are many, many stocks that actually are options eligible, where you could buy put options to trade a bearish directional bias on the unique.
I apologize. We're having some technical difficulties with the audio. I'm not sure, Jason, if you can hear us. Maybe if you can click on to mute and then unmute yourself, see if that will resolve the issue.
Hi there, guys. Sorry, it looks like I.
Hi, Jason. We lost you again.
All right, sorry there. Just for some reason my mic cut out and stopped working. So just maybe give me a confirmation that you can indeed hear me now.
We can hear you. It seems like it's been resolved.
All right.
Thanks.
Good. Yeah, good. No, I just switched out to a new microphone. So sorry about that, guys. All right. So let's continue. We want to understand that a call option will expire worthless if the underlying security is below the strike price. What we want to understand is that, of course, the time value will run out, at which case if there's no intrinsic value, then the option is going to be worthless and the premium will go towards the option writer. In the case of the put option will expire worthless if the underlying security is above the strike price purchased. And again, it's all of the time value will have disappeared. There's no intrinsic value on that option contract, so the option expires worthless, and it's an absolute loss to the option buyer. Now, I don't want to intimidate anybody by that, but it's very, very important that we understand that this is a consideration when we are looking at utilizing options as a stock replacement strategy. So we're going to move on here. We're going to take a look at utilizing covered calls in our registered accounts. You know, many investors, particularly those in the baby boomer sort of stage of things, are really very much focused on trying to generate just a steady, consistent cash flow in their registered accounts. And you know, they'll look to dividends, or they'll look for you know, some sort of an a money market, or a you know, a GIC, something that's paying out a interest. Now, of course, we recognize that returns on, you know, those interest-paying securities are not all that attractive. So what's interesting about the covered call strategy is that it kind of fits very nicely into those objectives, because what you can do is you can purchase, or you can already own you know, shares of a particular company. And it may so happen that those shares or that company is paying out a dividend. So, of course, you have the opportunity to collect that dividend. But what you're going to do is you're going to then sell a call option and get paid a premium for taking on an obligation to deliver those shares at a specific price over a specific period of time. So we have to kind of set
create a different sort of a mindset for this strategy, because a lot of investors, really cling to the belief that it's all about buying low and selling high, and we can still accomplish that when we're covered call writing. But the intention really here is just to how can we accelerate the cash flow and enhance the yield in our portfolio beyond traditional means. So the idea is that immediately when we sell that call option, we actually create static income up front. If it's 20 cents per share, 50 cents per share, whatever it is, it's going to be dependent upon, of course, the stock. But we create that static income. It actually also provides some added protection by reducing your cost base. So what it does is it brings premium into our account, which then mitigates some market volatility. Now, of course, volatility is just another way of saying, when a stock drops in value, we say that it's experiencing some quote-unquote volatility. But when you bring that additional premium into your account, it actually offsets some of that volatility. And you don't really need the investment to increase in value in order to generate a profit. Of course, you want that investment to increase in value, but the idea is that if you go through a month or 2 months where the stock happens to be somewhat static, you actually are in a position where you're still going to be able to generate some return. So I was looking at an example back. And this is an older example, but it actually played out very well. Back in November of 2013, we looked at buying 1,000 shares of XGD, and at the time, XGD was trading down at $10.50 per share. So you'd be able to bring in you'd be putting out $10,500. Now, of course, the XGD is the ETF that tracks the Canadian mining sector. And so what we could do is we could actually sell a $12 strike call against that, and so we could benefit from basically a $1.50 upside potential on the stock, but also collect a 60-cent premium as well. So if we sold 10 calls against those shares, we actually would collect about $600 in premium for that time frame. And so by doing that, we've created an obligation to deliver those 1,000 shares over the next 5.5 months at $12. But we've created about 6% cash flow in that 5-month period, plus about a 14% upside in share value. And so when we take a look at this, we want to recognize that if we consider upside potential plus returns on the premium, we're looking at a fairly attractive rate of return for that 5-month period. If the stock stays the same, we're still going to generate over that period about a 6% return. If the stock actually drops in value, we still actually maintain the value of our net position, and in fact still make a small percentage point. And if the stock actually drops considerably, we actually buffer or mitigate that drop because of the premium that we've collected. So the only challenge, of course, is that if the stock does go up substantially, then we're going to run the risk of not run the risk, but we're going to trade off that upside potential because of the premium that we've collected up front. So that's something that we psychologically have to wrap our head around. So just a sort of a consideration for this strategy as well. I like to use the analogy for the covered call writing. Similar to owning a rental property. In fact, for OptionSource.net, we have a newsletter that we call the stock rental business, because the idea is that if you own a rental property, you're going to research a neighborhood that's up and coming, where you see that there's the potential opportunity for growth. You're then going to find a home within that neighborhood that ideally has a solid foundation, and with the expectation that as the neighborhood appreciates, a good house is going to appreciate as well. And then you're going to ideally benefit from an appreciation in the value of that particular property. But what you don't do is you don't board up the windows and the doors and just wait for the market to appreciate. What you do is you add tenants to that property, and you generate cash flow on a month-over-month basis. And so that's what we want to look at as far as the rationale of the covered call strategy, is that you want to own good, solid, blue-chip companies that have the potential, even though markets are going to fluctuate, they have the potential of continuing higher over an extended period of time. And while those companies are paying you a dividend and ultimately you're taking advantage of the market appreciation, you're also collecting that rent to help pay, to help lower your cost basis or mitigate risk and all sorts of other things associated with holding a stock position. So it's kind of an interesting way to look at it. At least I find it is, and it helps put things into perspective when you own the stock, to recognize that there are other ways that you can profit than just dividends and share appreciation. Okay, so the last strategy we're going to look at before we take on any questions here, guys, is looking at utilizing the put protection in our registered accounts. And of course, the reason why we would consider adding puts as a method of protection is when we feel that the market is set to decline. We feel that there's greater risk of loss than there is potential for gain. And so for every 100 shares, we're going to buy one put option. Now, we're going to select the strike price where we would like to be, where we would like the stock to be protected at. And so what it does is it limits our losses. It guarantees the sale of the shares at that specific price that we've selected, but we still have the benefit of continued upside potential. So we paid a premium for a guaranteed downside protection over the life of the option contract. So I was looking at the S&P TSX Equal Weighted Bank Index. So this is the ZEB, considering owning 500 shares, and on March 26th, shares were trading at $21.60. And if we're concerned about short-term risk, let's say, for example, we've been profitable over the last several months, and now we're starting to feel that there's maybe a little overhead resistance and some potential short-term risk. What we want to do is we want to establish a guaranteed exit price if the shares drop in value, but at the same time, if the shares do continue higher, we want to make sure that we have an unlimited profit potential as it continues to work in our favor. So if our objective is to guarantee our sale, we have to choose a strike price that is that works for us. And so in this case, I looked at a guaranteed sale of 500 shares at $21. So we would buy the 21 strike put options, and for 500 shares we would need 5 put options. We'd pay out about 80 cents. Now we have to compensate for the 80-cent cost, and so we need to add that to the break-even point of our shares. So if we are locking in profits, we would have to subtract that 80 cents from our profits. If we're just buying the stock right now, we would have to add that premium to the cost of the shares, and then that would become our break-even point. But we want to recognize that that is a sunk cost. That's our cost of insurance. And so we take the stock purchase price, add the put cost, and that gives us our break-even point. But beyond that, our profit potential is unlimited. So what can we do in the event that the shares drop in value? Well, if the shares drop in value, we can exercise our put. So what we can do is we can actually give up the premium, but no matter how low the shares drop in value, we actually are able to guarantee the sale at $20. So if the ZEB drops to 15, we still have the right to sell shares at 20. We subtract the 80 cents, and that's our maximum loss, is the 80 cents that it costs us to buy that put option. So what we've done is we've limited the loss of 80 cents, which is the put premium, and then of course the difference between the share value and the strike. So we want to understand that if we bought the shares for higher than where we purchased the strike price, that also becomes a cost as well. And that's what I look at as the deductible. So if you think about, when we buy car insurance, the more we want to insure ourselves, the higher the premium. If we're willing to take on a little bit of a deductible, then that will substantially reduce the premium that we have to pay. So we always have to take into consideration the difference between the stock price and the strike price that we've purchased. But the main thing is, no matter how low the shares drop in value, you have locked in that sale price between now and the expiration date. So in this case, it'd be the third Friday of May. So it allows you to be a little bit more patient, not make any sort of emotional decision, not act irrationally. Just let the market do what it's going to do, with the recognition that no matter what happens, your loss has been capped, or you've cut any of your further losses at the strike price, again, plus the premium that you've paid. Now, you could also, if you felt that the stock was going to turn around and bounce, or you could continue to hold the shares and sell the put for its market value. So what you would do is you would collect the market value for the put, and you give up your any of your hedge, if you will. As soon as you sell that put back to the market, you do collect the market value for the put, but you have an unidentifiable risk exposure on the position. So once you get rid of that put option, you now just sit there like any sort of ordinary shareholder, and if the shares continue to drop in value, then you're going to be subjected to those losses. Now, what you can also do is you can roll the option by purchasing another put and at an adjusted strike and further out expiration. So, for example, the shares have dropped in value. Your put option is now worth X amount, and you feel that you still want to hold the stock, but you need that protection in place. You simply sell that put back to the market, and then with the proceeds generated from selling that put, you turn around and you go out another expiration month and maybe even down another strike price, so you can roll down and out and purchase another option contract and then continue to hold the shares just to see whether or not it's going to turn around and go back in your favor. The other consideration, of course, is that you can hold until expiration, and in-the-money put is automatically exercised at the close of the market on the expiration date. So that means that in this case, the shares would be sold at $20, and you would just incur that loss of 80 cent premium, because remember, that's all time value, and that time value goes to the option writer, and you have the benefit, of course, of selling the shares at that strike. But remember the auto exercise rule: if the option contract is in the money on expiration, you don't have to do anything. Just sit back, and the clearing corporation will take care of it for you. What we want to consider is that if we are continuously buying expensive puts, it's going to increase our break-even point. So what happens is, you have 80 cents this month, 80 cents the next month, 80 cents the next month, so on and so forth. You really need to see that stock make a substantial move in order for you to break even. So at some point, you have to recognize that maybe you're in the wrong position. Maybe the stock is not going to head in the direction that you anticipated, and you need to cut your losses. I kind of look at protected puts like a get-out-of-jail-free card. If the stock takes a wrong turn, you've got that protected put in place to reevaluate and consider what the right course of action is. Maybe you give it one more chance and you decide to stay with it to see. But at the end of the day, you need to recognize when you're perhaps in a bad investment, and it's time to look at a new opportunity, look at cutting your losses. So don't fall into the trap of always buying expensive put options or put options in general. learn to identify when it's appropriate and when it's not, and you can do that by any number of means. And one easy way is just looking at your technicals and identifying, overbought conditions and identifying when certain indicators are, changing direction and so on. And then you could look at strategically implementing that protective put. So with that in mind, guys, we want to understand that as an investor, you have a lot of alternatives beyond the traditional buy and hold approach in a registered account. And you can create income beyond traditional means such as dividends. In fact, again, you actually get to keep your dividends, plus you get the benefit from the cash flow produced from the call writing. This also allows you to reduce volatility and risk. And so, once again, when a market sells off, if you've been collecting premiums against the shares that you hold, if the stock drops, if the market drops 12%, and you've been able to collect 6% in covered call premium, you've just cut your volatility in half. So it becomes a very, very powerful way to offset that market volatility and market risk. Just a second, guys. Sorry, the slides aren't advancing through for me here. Not sure what's happening, guys. I'm not sure whether or not you guys have taken control back from me or what's happening. There we go. The final point as well, guys, is that you have the ability to leverage your capital as well with a defined risk. Now, that's not for everybody. Remember, that's a little, that's for somebody who's open to be a little bit more proactive. But it's definitely a strategy that you can implement. The first thing that you need to do is create a plan for yourself, and it's not the most enjoyable process to go through necessarily, but really sit down and figure out what it is that you're looking to accomplish, which strategies are going to help you meet those objectives, and then follow that plan and just understand what you can accomplish with options in those registered accounts. If you want more information, guys, we have blogs that we write, myself, Patrick, my partner, and Richard Croft. You can find that those at optionmatters.ca. As well, if you visit m-x.tv, you can access the video and webinar library where we've got a lot of sort of bite-sized presentations, if you will, that speak to a number of the smaller points, so you don't have to spend a full hour. They're usually about 10 minutes long. You can take advantage of that, plus trading guides, covered call calculators, option calculators. And if you visit m-x.ca, there's a really powerful trading simulator there which allows you to create these strategies in a real market environment. Of course, it's a demo account, but you can actually transact the trades, get a feel for the mechanics, and also see how they look within your account. And I think it's very, very important to try to access something like that, so that you just get a feel for what it's going to be like when you go to implement the real thing. So with that in mind, guys, that's it as far as the presentation, but open to questions at this point, and I'll just sit back here and you guys can fire away.
Great. Thanks, Jason. So just before we get to questions, a reminder to all attendees that if you wish to submit a question, hover over the right-hand side of your window, and you'll see a Q&A box appear. You can submit your question in there. We'll endeavor to get through as many questions as possible. We have a high number of attendees today. For those questions we don't get to, we'll endeavor to get a response by email by end of week, certainly before Friday comes around. So kick it off, Jason. Wondering if you can comment on what happens if a share pays a dividend and you have a covered call position in play.
Right. So the only time that that would be an issue is if the stock, or sorry, if the option contract that you have written is in fact in the money, because what that means is that a call option holder would have the right to take those shares from you. And so what can happen is, let's say, for example, the time value premium on that in-the-money call is 20 cents, and tomorrow it's the stock's paying out a 40-cent dividend. After all the costs associated, as the call option holder, I could exercise my right and give up that 20-cent time premium, collect the stock, and collect 40 cents in dividends. So there is the potential that if you hold the shares and you've written a call option and the shares are in the money, or sorry, the call's in the money and it's paying a dividend, you might get those shares called away. Now you still get the premium, but you won't have any shares to collect the dividend with.
Great. And this actually, this next question really ties into capital gains for strategies outside of a registered plan. So I wonder if you can explain the implications or the capital gains treatment of a purchase and sell of an option contract, and assuming that you've sold at a higher price than what you purchased at.
Well, first of all, there's a publication available on the Montreal Exchange site that was put together by KPMG, and it's essentially, the tax implications of trading options, outside of a registered account. And number one, I would always suggest that you speak with an accountant, of course. Number two, I can tell you that there seems to be a very sort of a gray area in terms of how options writing and generating cash flow and returns on with options are treated. And sort of a general consideration is that if the transactions take place within a month, then it could be considered as income. But then also it goes further to suggest that it also has to do with whether or not your sole income is being generated through options writing or options trading or stock trading in general. So in other words, if you get up in the morning and your sole objective is to analyze the markets and do your research and trade and invest, well, then there's a pretty good case for that being your job, if you will, and you'll be taxed accordingly. So it's always very important, number one, to make sure you're on the same page with your accountant. Make sure that you are very consistent with the way that you account for for your transactions, and just and take some time to understand that publication that can be found on the exchange site.
Wondering if you can just kind of reiterate or discuss what strategies are actually allowed within an RSP and TFSA. So some questions coming through about can I put a strangle on, can I put a straddle, so on and so forth. Wondering if you can comment.
Sure, yeah. So you can buy a call, you can buy a put. So subsequently you could buy a call and a put at the same time, which would be an answer to that straddle strangle question. So yes, you can implement a straddle strangle. You can, of course, do the covered call strategy as we've demonstrated. You could do the protective put strategy. You can also do the caller strategy, which is a combination of the two. You own the stock, you sell a call, you buy a put. Where the challenge lies is with any sort of spread-related strategy. So in other words, you can't do a debit spread, or you can't do a credit spread, or you can't do a naked option right, because in those circumstances, they would consider those strategies as being marginable, and because we're not able to trade on margin in our registered accounts, they're not. They don't allow you to do that. So, buy a call, buy a put, straddle, strangle, covered call, protective put, and any variation of those strategies. The caller strategy is what's permissible.
Great. Just a question about, I know we've talked about RSPs explicitly and also TFSAs. What about RIFs? Can clients put on strategies within or use options within a RIF account?
Yeah, so any registered account that you're able to open up and make and enable options in, you can use these strategies. So RRSPs, RIFs, education plans, tax-free savings account, absolutely. Those are all included in the registered accounts that you can use these strategies in.
Great. And wondering if you can just talk about the use of limit orders when putting on option positions, so when they would be appropriate. Wondering if you can comment there.
Well, it's just so a limit order obviously is just you defining the entry price, the price at which you're prepared to pay for a particular contract, or if you're an option writer, the amount that you're willing to accept if you're selling it, where you may consider a limit order is if you're looking at an option contract and the spread between the bid and the ask is a little is a little wide, and you want to see if you can get a better fill. So they're applicable in any number of different circumstances. The consideration is just whether or not you will get filled. And so I think that it's important to use limit orders to define your cost or entry price, but understand that there may have to be some adjustments made if you're finding that the market is not accepting that particular price point.
And when it comes to interlisted securities, in thinking of a covered call strategy where you have choice of markets, whether it's the Montreal Exchange or an option exchange in the U.S., what are some of the considerations an investor should think about when putting on or selling their call option?
Sure. A great question. I mean, number one, I guess it depends on whether or not you predominantly hold Canadian securities within your registered accounts, and what the cost is for you to convert Canadian to U.S. and subsequently buy U.S. securities. There are merits in trading on the U.S. side, but there's also merits in keeping it Canadian as well. And I think it really does depend on the individual. But just understand, if you're a Canadian investor and you're converting your capital to U.S. dollars, or you're trading in U.S. securities, you're also subjected to that currency risk as well, in the fluctuation of the U.S. dollar versus the Canadian dollar, plus any costs that you might incur with respect to having your capital converted back and forth. And some brokers will allow U.S. dollar-based registered accounts, and others will not. So you just have to kind of take it from there and take a look at your own sort of unique situation.
Okay. And one question here, just seeking confirmation, I guess, on the mechanics of covered call strategy. So if they're selling covered call, just confirming whether or not they need to hold on to the underlying security until the option expires.
Yeah, absolutely. So the idea behind a covered call is we understand as the option writer, we sell a call option and we collect a premium, and we take on an obligation to deliver the underlying shares at that specified price. So the reason why it's referred to as a covered call strategy is because that obligation is covered by the shares that we own. What happens is, if we get rid of the shares, number one, we can't do that in our registered accounts. It would leave us with a naked call, if you will. And so we would have an obligation with no underlying, and that means that we're subjected to significant risk if the shares actually do increase substantially in value. We would have to go out in the market, buy those shares, and deliver them at the strike price that we said we would deliver them at. So we really do need to keep the stock in place as long as we have that written call in place. If we want to offset the position, we need to buy back the written call first, and then we could get rid of our shares.
Right. I'm just wondering, and you've covered this probably in the presentation, just looking for you to clarify the obligations of the option, let's say the call seller in a covered call situation, specifically related to the purchaser of that call option. Do they have a right to exercise before the option expires.
Sure, yeah. So when we sell a call option, what we're doing is we're getting paid to assume an obligation. We're getting paid to sell our shares at a certain price. That's the bottom line. So there's no guarantee that the shares are going to trade up to that level. It just depends on the strike price. But somebody is willing to pay us for the opportunity to own those shares at that strike. Now, the only time that that obligation is valid is when the shares are trading essentially 1 penny above that strike price. So if the shares are below that, then the option contract's going to expire worthless, and you know, we keep the premium, we keep the shares. If the stock trades anywhere above that within the options expiration cycle, the option buyer, the person who bought that option contract from us, and I'll you know, even though it's not a person, but an individual who bought that contract does have the right to exercise at any time. And what they're doing is they're asking themselves the question, is the risk of taking these shares right now worth giving up this call option that has a limited risk exposure? So in other words, the call option buyer has the right to own that stock no matter no matter how high it goes within the time frame that it's that it's valid. And so there's no real immediate need to exercise their right unless it's, of course, as we mentioned earlier, to grab that dividend. But the other consideration as well is that let's say I paid $1.50 for the call option. If it's a 20-strike call and the stock is just at $20, if I exercise my right, I would be giving up $1.50 and taking the shares at 20. Well, the market value is only 20, so I would actually be immediately incurring a loss of $1.50. So it's really not worthwhile for the option buyer to exercise unless there's genuinely a financial benefit. So in other words, there's no time value left and they're going to catch a dividend, or if there's no time value left and the stock, the option is sufficiently in the money and beyond the break-even point. Other than that, a lot of option contracts go unexercised, if you will, until expiration.
Great. And just this is an interesting segue. Any foreign content limits in registered plans that investors should be wary of? So whether or not they have a limit?
No, there used to be, but and I would always encourage individuals to just dig deeper into, of course, and you could probably answer to this a little bit more specifically than I could with respect to just some of the limitations within the registered accounts, because I know it does differ from broker to broker. But again, it's very much up to the individual, provided that they've set their account up to hold both U.S. and Canadian securities as to the composition of how they've allocated their capital.
Okay. And then just one follow-up question: any position limits on option contracts that investors should be wary of?
There is to a certain extent, but you would have to be swinging a pretty big line in the markets to ever get to those levels. I can't even remember what they are. I'm not there, I'll tell you that much. We're talking about thousands and thousands of contracts. So for an average investor who's looking to buy or sell 10, 20, 30, 50 contracts, even 100 contracts, 200 contracts, 500 contracts, there are no limitations. It's just when you get up into some of the bigger numbers where there are some limitations.
Right. And with that, we'll wrap up Q&A. Apologize to all attendees' questions who we did not get to, but as I mentioned on the outset of this session, that we'll get back to you by email within the coming days. So thanks once again to Jayson, another excellent presentation, and the Montreal Exchange. And reiterate to those attendees who did not get any portion or missed some of the presentation today or wish to replay, it will be available under our Learning Center online within a couple of weeks. So thanks again, everybody, for coming out. Thanks again, Jayson.
My pleasure. Thanks, everybody, and we'll catch you again in a couple of weeks, I think.
Right.